Listen, I need you to pay very close attention to what I'm about to tell you, because what's happening right now in the silver market is something most people won't see coming until it's too late. And by then, the opportunity will be gone. Completely gone. Right now, as I'm recording this, silver is trading just under $30 an ounce. And I know what you're thinking. You've heard this before. You've heard people say silver's about to explode for years. Maybe you've even bought some yourself and watched it go nowhere. I get it. I understand the skepticism. But what's happening right now is fundamentally different from anything we've seen in the past decade. And if you don't understand why, you're going to miss the biggest wealth transfer opportunity of your lifetime. Let me paint you a picture of what's actually happening behind the scenes. While everyone's focused on gold hitting new all-time highs, silver has been quietly setting up for something extraordinary, and the smart money knows it. They're not talking about it on CNBC. They're not writing headlines about it in the Wall Street Journal, but they're accumulating heavily. Just last month, the Silver Institute released data showing that industrial demand for silver hit an all-time record. We're talking about 654 million ounces consumed in industrial applications alone. That's not jewelry. That's not investment. That's actual physical silver being used up in solar panels, electric vehicles, 5G infrastructure, and electronics that will never be recovered. It's gone, permanently removed from the supply pool. Now here's where it gets interesting. Total global silver production last year was around 830 million ounces. Sounds like plenty, right? Wrong. Because when you add investment demand, jewelry fabrication, and silverware on top of that industrial consumption, we're looking at total demand exceeding 1.2 billion ounces. The deficit is being filled by above-ground stockpiles that have been accumulated over decades, and those stockpiles are running dry. I want you to think about something for a second. In 1980, when silver hit $50 an ounce, there were approximately 3.5 billion ounces of above-ground silver available for investment. Today, that number has collapsed to less than 1.5 billion ounces. We've consumed more than half of the world's available silver in just 4 decades, and the rate of consumption is accelerating, not slowing down. The solar industry alone is projected to consume 85% more silver by 2027 than it did in 2023. Electric vehicles use twice as much silver as traditional cars. Every 5G cell tower requires significantly more silver than 4G infrastructure. We're in the middle of a technological revolution that is absolutely dependent on silver, and nobody's talking about what happens when the supply runs out. But here's what really keeps me up at night: the gold to silver ratio. Right now, silver is trading at about 90 to 1 against gold. That means it takes 90 ounces of silver to buy 1 ounce of gold. Historically, that ratio has averaged around 60 to 1. During the 2011 precious metals bull run, it dropped to 32 to 1. In 1980, it briefly touched 17 to 1. What does this tell us? It tells us that silver is historically, dramatically, absurdly undervalued relative to gold. And when that ratio corrects, and it always corrects, the move in silver is going to be violent. If silver just returned to its historical average ratio with gold at 60 to 1, and gold stays where it is today around $2,700, silver would be trading at $45 an ounce. That's a 50% gain from current levels. But if we see the kind of ratio compression we saw in 1980 or 2011, we're talking about silver at $80, $100, even $150 an ounce. Now, I know some of you are thinking this sounds too good to be true, so let me show you what the institutions are doing, because they don't make moves based on hope or hype. They make moves based on data and positioning. The Commodity Futures Trading Commission releases a report every week called the Commitments of Traders Report. It shows us exactly what the big commercial banks, the hedge funds, and the large speculators are doing in the futures market. And what we're seeing right now is fascinating. The commercial banks, who are typically short silver because they're hedging physical production, have reduced their short positions to levels we haven't seen in over a decade. They're covering. They're getting out of the way. At the same time, the managed money, the big hedge funds, are starting to build long positions. Not aggressively yet, but they're positioning. They're getting ready because they can see what's coming. And then there's what's happening in the physical market. The United States Mint sold more Silver Eagles in the first quarter of this year than in any first quarter in history. Premiums on physical silver, the amount you pay above the spot price to actually get your hands on a coin or bar, have been elevated for months. In some cases, you're paying $3 to $5 over spot just to get delivery. That's not normal. That's a sign of physical tightness in the market. The COMEX, the big commodity exchange in New York where silver futures are traded, has seen its registered silver inventories, the silver that's actually available for delivery, drop by 35% in the last 18 months. We're now sitting at around 45 million ounces of registered silver backing a market where the open interest represents claims on more than 900 million ounces. Think about that. There are claims on 20 times more silver than actually exists in deliverable form. This is a powder keg, and all it takes is one spark, one major player standing for delivery, one supply disruption, one geopolitical event, and this whole thing unwinds in a way that's going to shock people. Let me tell you a story. In 2008, during the financial crisis, there was a brief moment when you literally could not buy physical silver at any price. The spot price on the screen said $14. But try finding a dealer who had any in stock. And if you did find one, they were charging $25, $30, even $35 an ounce. The paper price and the physical price completely disconnected. People who waited, thinking they'd buy when it got cheaper, ended up paying more than double or not getting any at all. I'm not saying we're there yet, but I am saying the warning signs are flashing. And the people who understand market structure, who understand supply and demand fundamentals, are not waiting around to see what happens. Now, let's talk about something most silver investors don't think about but absolutely should. The monetary aspect. Because silver isn't just an industrial metal. It's been money for 5,000 years. And in times of currency crisis, people remember that. Right now, we're watching the global monetary system go through changes that haven't happened in 50 years. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to create alternatives to the dollar-based system. They're settling trade in their own currencies. They're talking about a commodity-backed currency. And while gold gets all the attention in these discussions, silver has always been the people's money. It's affordable, it's divisible, it's recognizable. If we see any kind of currency crisis, any kind of loss of confidence in fiat money, silver is going to be the asset that everyday people turn to. Not gold at $2,700 an ounce, silver at under $30. They'll be able to afford it. They'll be able to use it. And the demand will be unlike anything we've ever seen. I want to share something with you that might be relevant depending on your situation. If you're sitting on a significant retirement account, maybe $100,000 or more in a 401k or IRA, there's actually a way to get physical precious metals into those accounts without triggering taxes or penalties. It's called a gold IRA, though you can hold silver in them too. I put together a free guide that explains exactly how it works, what the rules are, and how to set one up if it makes sense for your situation. You'll find it in the description below. No obligation, just information. Worth looking at if you're thinking about protecting part of your retirement with hard assets. All right, back to what's happening in the market right now. Because here's what people need to understand about timing. Markets don't move in straight lines. They don't give you perfect entry points with a big flashing sign that says, buy here. They give you windows, brief periods where everything lines up, where the fundamentals are screaming one direction, but the price hasn't caught up yet. And those windows close fast. In 2020, silver was trading at $12 an ounce in March. By August, it was at $29. That's a 140% move in 5 months. The people who bought at $12 made life-changing returns. The people who waited for it to get cheaper never got another chance. It never went back to 12. It never went back to 15. It found a new floor in the low 20s and has been building from there ever since. Right now, we're in another one of those windows. Silver has been consolidating in this $22 to $30 range for 3 years. It's tested the bottom of that range multiple times and held. It's tested the top multiple times and gotten rejected. But each time it tests that $30 level, it's getting stronger. The selling pressure is diminishing. The buying pressure is building. And when it finally breaks through, and it will break through, the move is going to be fast and furious. Technical analysts call this a bull flag or a consolidation pattern. It's what happens when a market takes a breather after a big move, builds energy, and then explodes higher. We saw this exact pattern in 2010 before silver went from $18 to $50 in less than a year. We're seeing it again right now. But here's the thing about technical patterns. They only work when they're backed by fundamentals. And the fundamentals for silver right now are the strongest they've been in decades. We've got supply deficits, we've got industrial demand at all-time highs, we've got investment demand picking up, we've got a gold-to-silver ratio that's historically stretched, we've got geopolitical uncertainty, we've got currency concerns, We've got inflation that's not going away no matter what the government tells you. Every single fundamental driver is pointing in the same direction, up. And yet, silver is still under $30, still affordable, still accessible, still available in size if you know where to look. But that window is closing fast. Let me tell you what's going to happen when silver breaks through $30 and holds. The algorithms are going to kick in. The momentum traders are going to pile in. The headlines are going to start appearing. And suddenly, everyone who's been ignoring silver for the last 3 years is going to want some. The premiums are going to spike. The wait times are going to extend. The dealers are going to run low on inventory. And the price is going to gap higher in a way that leaves people shocked. I've seen this movie before. In 2011, I watched silver go from $26 to $35 in 3 weeks, then from $35 to $48 in another 2 weeks. People who were waiting for a pullback never got one. By the time they decided to buy, they were paying $45 for something they could have bought at $26 just a month earlier. The same thing happened in 2020. Silver went from $18 to $29 in 4 months. No significant pullbacks, no second chances. Just a relentless grind higher that left the skeptics on the sidelines. And here's what's different this time. In 2011, the move was driven primarily by investment demand. People were scared about the financial system after 2008. They were buying silver as a safe haven. But the industrial demand wasn't there like it is today. The supply deficits weren't structural like they are today. When the fear subsided, the investment demand dried up, and silver corrected hard. This time, the industrial demand is real and growing. The supply deficits are structural and widening. Even if investment demand stays modest, the fundamentals support much higher prices. And when investment demand does kick in, and it will, we're going to see a move that makes 2011 look tame. Think about what's required to meet the projected industrial demand over the next 5 years. We need to find and produce an additional 200 million ounces of silver annually just to keep up with solar panel production growth. That's not counting electric vehicles. That's not counting 5G. That's not counting all the other industrial applications. Just solar. Where's that silver going to come from? We're not discovering major new silver deposits. The existing mines are mature and production is flat to declining. Recycling can only provide so much. The only way to balance the market is through higher prices. Significantly higher prices. Prices that make marginal deposits economical to mine. Prices that incentivize more recycling. Prices that ration demand. And that's exactly what we're going to see. The market is going to force silver higher because there's no other way to balance supply and demand. It's not a question of if. It's a question of when. And all the signs are pointing to when being right now. I want you to think about your own situation for a moment. If silver goes to $50 an ounce, which is not some wild prediction but simply a return to the 1980 and 2011 highs, that's a 70% gain from current levels. If you put $10,000 into silver today, that's $17,000. If you put $50,000 in, that's $85,000. If you put $100,000 in, that's $170,000. But here's the thing, $50 might just be the beginning. Because unlike 1980 and 2011, we now have structural industrial demand that didn't exist back then. We have supply deficits that are real and growing. We have a monetary system that's increasingly unstable. We have geopolitical tensions that are escalating. We have all the ingredients for a move that goes well beyond $50. Some analysts are talking about silver at $100. Some are talking about $150. Some are even talking about $200 or higher. Are they right? I don't know. Nobody knows. But what I do know is that the risk-reward at current levels is extraordinarily compelling. The downside is limited. Silver has strong support in the low 20s. The upside is potentially massive. We're talking about multiples of your investment, not just percentages. And here's what people need to understand about precious metals. They're not like stocks. You can't just click a button and buy $1 million worth at the current price. There's a physical component. There's production capacity. There's delivery logistics. When demand surges, the system can't keep up. Premiums explode. Wait times extend. Availability disappears. I'm already seeing this in certain products. Try buying a 100-ounce silver bar right now from a major dealer. You're looking at 2 to 4 week delivery times and premiums of $2 to $3 over spot. That's not normal. That's a sign that the physical market is already tightening even though the price hasn't moved yet. What happens when the price does move? What happens when silver breaks 30 and heads to 35, then 40, then 50? The premiums are going to go to $5, $7, $10 over spot. The delivery times are going to go to 6 weeks, 8 weeks, 3 months. And a lot of people are going to be priced out or forced to wait while the price runs away from them. This is why the time to act is now. Not when silver hits 35 and everyone's talking about it. Not when it hits 40 and the headlines are screaming. Now, when it's still under 30, when it's still available. When you can still get it at reasonable premiums with reasonable delivery times. Because let me tell you what's going to happen. Silver is going to break through $30. It's going to consolidate briefly, maybe pull back $1 or $2, and then it's going to run. It's going to hit 35, then 40, then 45. And at each level, people are going to say, I should have bought at 30. Then I should have bought at 35. Then I should have bought at 40. And the people who did buy at under 30 are going to be sitting on gains that most investors only dream about. They're going to have positioned themselves in front of one of the biggest commodity moves of the decade. They're going to have protected their wealth from currency debasement and inflation. They're going to have given themselves optionality and security in an increasingly uncertain world. Look, I'm not here to tell you what to do with your money. That's your decision. But I am here to show you what's happening, to connect the dots, to give you information that the mainstream financial media isn't covering because they're too busy talking about the latest tech stock or cryptocurrency. The silver market is setting up for something extraordinary. The fundamentals have never been stronger. The technical setup has never been more compelling. The risk reward has never been more favorable. And the window to get positioned at under $30 is closing rapidly. You can wait and see what happens. You can hope for a better entry point. You can tell yourself you'll buy when you're more certain. But I'm telling you, based on everything I'm seeing in this market, based on the data, based on the positioning, based on the fundamentals, that approach is going to cost you. It's going to cost you the opportunity to buy at these levels. It's going to cost you the gains that are coming. And it's going to cost you the peace of mind that comes from being positioned in a hard asset that's held value for thousands of years. The last chance to buy silver under $30 is right now. Not next week, not next month, now. Because once this breaks, once the momentum kicks in, once the algorithms start firing, once the headlines start appearing, it's going to be too late. The opportunity will be gone, and you'll be left wondering why you didn't act when you had the chance. Don't let that happen. Don't be the person who looks back 6 months from now, or a year from now, when silver's at $50 or $60 or $70 and regrets not taking action today. The information is in front of you. The opportunity is in front of you. The only question is whether you're going to seize it or let it pass you by.